We work with emerging managers, and we define that as a manager that has under 300 million, even though some of our clients are multi-billion-dollar hedge funds. We're specifically in the alternative space, so we work with long short, option trading, and credit long short and commodities. Don't do much in the futures space. We've been around for about 30 years. We have offices in New York, New Jersey, and in Florida. Lucky me. We work with managers to really provide their technology platform for their buys and sells. So that is our main business. We also offer cap intro. So we do a great job in getting allocators and investors in front of managers, specifically those allocators that are interested in emerging managers. They may have a sleeve of assets that they're specifically gearing towards the emerging manager. Previously, I ran a family office, and prior to that, I was a partner in a long short equity hedge fund. So I've been in this industry for a few decades. And with that introduction, I will turn it over to my friend Blake.
Thank you, Suzanne. Mark, thank you. Marty, wherever you are there, thank you. Years in the business. We actually were Smith Barney's very first prime brokerage client. They brought somebody from the dividend department to cover us, which was interesting. That was a long time ago. I'm Blake Singer. I am a managing director at Amera Securities, which is one of the hats I wear. Amera Securities does some investment banking for emerging healthcare and technology companies, basically A through D round type financing. And the majority of my work, though, is working with Luis. Actually, we work together and provide outsourced CIO work. My background, I ran a traditional investment management firm for a number of years, about a $400 million stat arb hedge fund, a volatility arb hedge fund. We had a fund of funds back when they had fund of funds. Then worked, I'm from Oregon originally, and worked with a family office and had a commodity trading company as well. So we provide outsourced CIO solutions. We have one client in Pennsylvania, which is a registered investment firm. And I met Luis 10 years ago on LinkedIn. He was working on his PhD at University of Pennsylvania, and we kept in touch for a decade. And finally, over the last couple of years, we've been working together. So fantastic. I'll pitch it to Luis.
Yeah. As Blake noted, we met when I was a PhD candidate at Penn. We worked together on a market neutral strategy when I left Penn. And then subsequently, when I left the fund that we launched, started a pool of capital with some buddies of mine, convinced them to leave Chicago and New York. And we pooled some assets and brought in a couple of outside investors, enough to remain under a de minimis exemption to not register with any regulators or administrators. And they eventually divested and went on other interesting career paths. And so I consolidated the firm into a quasi-family office that's effectively a family holding company. A lot of the intellectual property and a lot of the research and the investment thesis that we share with two clients. One that Blake mentioned is a firm based out of Malvern, PA. We built a really, really unique and alternatives platform, providing access to emerging managers ranging from 10 to $150 million in AUM, all the way to kind of the big box names that everyone knows, the Blackstones, the Vista Equity Partners, the Pantheon Ventures, the Galaxy Digitals, et cetera. So the idea for this firm was to create a platform that democratizes access to high net worth who, their AUM just doesn't make sense to have a family office, but also make it scalable for, basically anyone who's eligible as an investor and where it makes suitability and fiduciary sense for their portfolio. So we ultimately wanted to create an endowment model that is scalable for high net worth, ultra high net worth, and small and mid-sized institutional investors.
Luis, you spoke last, so you get the first question. So for the last 10 years, the market's been characterized by low volatility, steady growth, low inflation, low interest rates. And recently things have changed. So we're quickly moving to a new market cycle. And I think what people would like to know is, where are the opportunities in this new market cycle? Where are you talking to your clients about? What are you pointing them towards?
So I've over the last year, I've worked to shift clients out of traditional fixed income for clients focused on cash flow generating vehicles. We look to the private market space, whether in real estate or in the private credit space. Also in, one of the emerging managers that a good buddy of mine who ran an inflation's derivatives desks at some premier banks, he launched a CPI mirror strategy. So for folks who are looking to protect purchasing power of cash, liquidity needs, treasury needs, that's an area that we've been helping him raise assets for. Real estate and real assets more broadly. So things in that area. Yeah.
Okay. Suzanne, are you seeing a lot of solutions come your way in that space? And are you taking them out to market on your capital intros?
Oh boy, there's a loaded question.
I try.
I sense from the family offices that we deal with, the allocators that we deal with, that they're very interested in obviously diversifying strategies, but there's a very tentative viewpoint out here right now, because I think that trying to understand where interest rates are going to really drive a lot of people's allocations. We've seen a lot of thematic approaches, meaning managers that want to take a particular theme, such as electric cars, batteries, anything that might be of the reopening trade of after COVID. And these are short-term strategies that are kind of the cherry on the sundae, as I like to call them. But I agree with Luis that the fixed income market has been very challenging for managers, just because there's just not a lot of cash generation in that world. Cash generating strategies have historically been very, very interesting. But I reflect back on conversations I had with a guy like John Levin Capital Strategies, who's one of the most brilliant guys in the market still today. And he and I used to talk, and this would be about 10 years ago, and he would say, Suzanne, the market's at 12,000. What are investors going to do when the market's at 30,000? And I would sit there and say, John, you're smoking crack. The market at 30,000? You have to be kidding me. And he said, it'll get to 30,000 quicker than you think, Suzanne, but the volatility is going to kill many, many investors that are expecting the steady eddy growth and return. So I think John's words still ring in my ears as to what people are looking for, et cetera, et cetera. There's also been a decided viewpoint of, and we'll certainly go into this in a little while, of what philanthropy and what are you doing for the community as a money manager. We're seeing that in hires, Wall Street hires, and we're seeing that certainly in employee hiring, et cetera. There's been a huge shift, particularly during COVID, where people were disenfranchised due to no fault of their own. We, in fact, at Celadon, created the Celadon Foundation. And so what we have done is we take a percentage of the commission that we charge to our trading clients, and we give it to charities that are designated by that money manager. It's quite a unique approach, but we think we're on a huge data point trend right now.
Okay, I'm going to draw on your medical background and your history there. 2 years ago, healthcare exploded for obvious reasons in terms of investment and people wanting to be in that space. Is that continuing? Is that diminishing? Is that leveled off? What are you seeing? What are you hearing?
Well, like medical technology, right? It's always evolving. And there are kind of always new frontiers, if you will. And so I would say that is something that will continue to morph and evolve and provide opportunity for as long as I can see. There are amazing cancer solutions. We are working with a company that provides an amazing solution for postpartum hemorrhaging. And there's a gentleman actually going to be talking later today that does cell biology tools that is very interesting. I met him in Austin. So, I would say that the way that we approach things like healthcare or technology or credit or income is not so much to look at the whole asset class, but really to drill down and be investors rather than allocators. So we really focus on what's the company doing, what is their niche? Do they have a moat around their business? We tend to prefer in healthcare companies that don't have binary outcomes. So rather than waiting for an FDA approval, I'd rather be in something that has a little bit further down the path a little bit. I think that there is a great deal of opportunity in healthcare medical device areas. And oftentimes those aren't really IPOs, they're single product or multi-product. But there is a huge M&A activity from, the majors to buy these, like in Dickinson, J&J, whatever, and they'll buy them at certain points. So the exits are really more strategic than IPOs, but they're great multiples.
I'm going to do something I don't regularly do. Emma, you invest in very early stage companies. And healthcare particularly is one of your 5 sectors, I think you told me. Any color to add to what Blake just said there? Or, since you're dealing with the really nascent companies at the very beginning, what do you see?
Yeah, I think we see a ton, and we also do less kind of med tech and biotech, and we do more, we call it the care economy. So it's kind of thinking about care from a broad-based perspective. It's everything from traditional healthcare to mental health, elder care, child care, pet care, personal care, everything in between. I think we're seeing a lot in terms of solutions that are really about broadening access and sort of rethinking traditional models to make things more affordable, more accessible, more efficacious is a lot of what we're seeing.
I've got everybody nervous at the table. Who might be next?
We actually do, and just to what Blake's point, we do a lot of work with the strategic partners. If we could get us a JV collaboration partnership agreement, reach certain milestones that help with the development, the FDA, and they make the acquisition. So you're right, I agree with you. We don't need the IPOs, but if you can get bought by a J&J, and there's any number of companies that are in line to do that, that's the bigger companies actually like it too, because it helps on their innovation side. They look at universities and elsewhere for that new stuff, and there's lots of it.
It reduces the risk a lot.
Exactly. Yeah. Especially when they get to a later stage. Yeah.
Suzanne, I want to sort of pick up on this whole theme here, especially with the emerging managers that you represent, because markets like this, where you have this change going on that's so dramatic, that dries up some markets and creates others. So what are the areas you're looking at to take out clients and to represent to your, people you do capital raising from?
Yeah, there was an enormous drive in the last, I would say, 5 to 7 years on the ESG front. I'm finding that flattening a little bit right at this juncture. I'm seeing, again, and I sense it's, again, my friend John Levin and his comments on volatility, We're seeing a lot of volatility trading that is in vogue, and certainly trading of index options. Thematic equity investing I touched upon before. It used to be GARP, which is growth at a reasonable price. Now it seems to be growth at any price. So that's a little bit interesting. Thank you. I'm here all week. And yield plays, and with, trying to read the interest rate tea leaves is clearly a parlor game, but it extends quite significantly into the manager selection area as well. I do think, though, that the manager that comes out to a allocation group and says, we do our research, we know our stocks better, it has to be more than that. So whatever sector one is involved in, I like your comment on the care economy. That's not a term that I have heard until this morning, and I like that because I've been trying to kind of put arms around exactly what you're talking about, whether it's pet care, elder care, pediatric care, cancer care, and things like that. I love that care economy. So those are the areas that we see are coming. We're not seeing a lot of lift outs, and I suspect COVID had a lot to do with that. And a lift out I defined as sort of two guys that were with, a particular hedge fund that lift out and do their own thing. They might have worked for Appaloosa or something like that and start their own fund and so on. Not seeing a lot of that right now. And I suspect it's because funding on day one has been limited. COVID has slowed down allocations significantly. Zoom calls, while they're very efficient, hello everyone, they are not good in the cap intro space to the extent that I can't tell you of the thousands of Zoom calls that we did for allocators in the last 2 years. There hasn't been one that said, let me get my checkbook, 25 million, let's go for this particular manager. It takes time, and that's slowed down the due diligence process for many, particularly in the emerging manager space. And we saw a lot of emerging managers get their funding pulled. We teed up probably 40 to 50 new strategies in the last year, and probably half of them got their seed money pulled because investors who would be normally allocating to emerging managers said, you know what, I don't know what the outcome is of this COVID thing. I'm going to wait. I'm going to stay with who I know. I've been at the dance now with a certain amount of managers, and I want to stay there, as opposed to adding in some more diversifying strategies.
I wanted to touch on something you spoke about, volatility trading and the popularity of that currently. And I would think that's an area that requires a certain amount of sophistication from your back office and systems and things like that. So you're in your diligence process before you take out a manager on the roadshow or anything. Are you looking at their systems? Are you testing their system?
Absolutely right. And technology is everything. We also work with our managers to get them ready for prime time, because so many managers get out there and they start speaking in a language that the audience hasn't a clue as to what they're talking about, even very sophisticated allocators. And so we have to get them ready for prime time. It's no different than opening night at a Broadway show. You've got to be ready, and you've got to be ready to handle the types of questions. Our goal is simple. We want to compress that sales cycle from finding the allocator that has appetite for your strategy to having your strategy ready to go, putting that together and having a marriage take place, so to speak. We're probably nothing more than, Dolly Levy's in the final analysis. Thanks for getting that reference.
Like I threw the fun side out to Suzanne there. So I'm going to flip that over and say, there's new market cycles create opportunities and they take away opportunities. So which areas right now are you seeing as being more risky than perhaps they were a few years ago?
Well, bonds. I've been a big believer that anytime there's a really crowded trade and it's really popular, we may not see what is going to be on the back end of that popularity, but generally popularity and crowded trades don't work out for the participants in those at the later stages. So.
And like Robin Hood.
Yeah, and there's an old Wayne Gretzky saying that, he used to skate to where the puck's going to be rather than to where it is, which makes sense. So I would say that, there's been a huge proliferation of private credit, and it's been great, but I look at that and say, not everybody can be successful, right? And most 99% of the private credit is based on floating rate notes. So I would be very leery of being anywhere in private credit, not in the senior tranches at the top of the credit stack. And just as what happened with the adjustable rate mortgages in 2008, 2007, as those began to click up, more people that went into a house that couldn't afford a 6% interest rate, and they came in with a teaser at 2. Well, again, not in the top stack of private credit, but in the lower middle part, I would be a little bit leery, because as all these floating rate notes begin to tick up, and we're seeing it, it's going to really impact, I believe, some of the cash flows of some of these companies. I think that at the top of the credit stack, the larger, more complex deals, the $500 million credit deals, I'm less worried about that. It's really some of the more emerging private credit firms.
Gotcha. So basically bonds and credit.
Well, no,
That side
I
of
love
the-
credit. but,
Anything on the equity side that you're sort of steering away from?
I've always had this negative. I mean, I'm an equity guy as well, but having been kind of a longtime value investor, I really, I'd be very cautious of, some of the areas that have been, like some of the FANG stocks, right? Even though they've come down, I just can't, and Luis can, but I can't buy a Tesla at these prices. And that's probably why it's going up so much.
Car or the stock?
The stock.
It's the popularity thing you just spoke about.
Did you have
So
any,
I try to
Twitter
take
stock?
a real
Did you have any
control.
Twitter stock?
Huh?
Did you have any Twitter stock?
No,
No.
no.
That would have been valuable.
So, Luis is much more opportunistic than I am. I'm more value when it comes to the equity side, and I don't think we're there yet, seeing a lot of juicy values.
Oh, that ties right in. That's kind of interesting. So, Luis, through the years, I've spoken to a lot of LPs, gatekeepers, CIOs. I'm curious about how you source your deals. Are you more opportunistic, or are you more methodical? And maybe he's already given us a little bit of an insight into your answer here.
Yeah, so I am opportunistic, and what I look at is kind of time horizon and what liquidity needs are for the client. Based on that time horizon, I look at the opportunities present and the direction where those opportunities are going. So for example, in a very low inflationary environment, which we saw pre-pandemic, okay, low interest rates, an area that I found to be incredibly attractive was farmland. So it was an opportunistic time to get exposure to farmland, identify farmland that has strong water rights and strong access to water. You don't want to be in Arizona, not and get cut off from the Colorado River. You don't want to deal with being in California and then there's a drought and then they say you have to reduce your water by 27%, which means you have to buy water from alternative sources. So that was one area that I saw that met a particular thematic play on food security, water security, and identifying a huge misprice in that space. Go figure, pandemic came and food prices jumped because of supply chain disruptions, and it's been an incredibly virtuous investment opportunity that we had took on, and we also introduced to clients over the last year. Yeah. Did I answer the question?
Well, you did. You did that in the
Just wanna
first
make
30
sure.
seconds. You said you're more
Yeah.
opportunistic.
Yeah. I mean, I'm happy to, I want to, I'm happy to go into, other areas that I found interesting over time and are still finding interesting, but.
Well, I think what people would want to know, what are you opportunistic about right now?
So, I guess part of it is for the ESG focused investors. I think nuclear power is incredibly and the areas in uranium are very interesting. If you look at solar and wind turbines, they're great. The problem with that using and relying that as a source of clean energy is the problem is a battery capacity. Lithium battery storage capacity is about 8 hours. Maybe with advances, we might peak out around 12. So we need to advance energy storage. So within that context, you look at what's called base load energy. It's the minimum energy required to provide power to a given population. Wind turbines and solar are just not sufficient to be able to power places like New York, like Lagos, like Accra, like Miami, like London. And so if you're trying to go into, if you're making a bet on an ESG social policy as it relates to climate change and trying to do better for the environment, nuclear is the only way to go. And you can look at where uranium prices were trading back in the 2000s on a per pound basis. It's probably about $150 a pound. On inflation adjusted basis, it's probably closer to 200. And today it's trading at around $60 per pound. If you evaluate certain firms like Duke Energy signing a deal with Lotus Resources, effectively signing a long-term contract to reopen those mines, with a floor price of $75 and with a floater as uranium prices go up, that gives you an idea of where the market is pricing uranium. There are other drivers to the thesis, but that's a really, really interesting area. European banks were incredibly interesting, in the beginning of March, because folks were trying to understand, well, what was the exposure to Russia, directly or indirectly? And so you had a bunch of European banks trading at half book value, where they maybe at 1% to 2% exposure at most at any given major bank in Europe. So that created a short-term opportunity. I think going back to the uranium, that's all you need to do is look at the number of nuclear reactors under construction, and that will be activated over the next 10 years. And you look at our existing supply chain, particularly now with the sanctions with Russia. That's probably one of the, I would say, is one of my biggest bets that I've ever made in that space. And it's ESG. It's not clean energy, but it will provide a non-carbon footprint to what we're looking to achieve.
Clean, but not- That's clean.
And I think, the last, there are other areas, and I'm happy to talk about it, at any other point after this conference, but another area that I think is really interesting, and you'll find that many investors, not all, and I wouldn't go as far as saying the majority, but many investors start to flatten the ESG requirements in very volatile environment, in a very volatile space, because they're looking to still find opportunities to make money. It doesn't mean that certain investors will completely abandon ESG, but a little more flexibility. For the folks who are not ESG, I think there's incredible opportunity in the coal space, particularly in light of the energy crisis that we saw in in Europe in Q3 and Q4 of last year, and which has been grossly exacerbated with the current situation in Ukraine. So I think the area where I was looking at coal originally was on coking coal as a function of producing steel. But now that's been an exacerbated play because of thermal. So the thermal energy is it's a huge play, and I think there's a great opportunity for cash flow and providing credit to the coal industry.
That's fantastic. You really gave us a lot of insight about how you think, how you approach. I think people got a lot out of that. Thank you, Luis. Blake, I'm going to come back to you here a little bit, sort of on the same thing, but as you're, go up to your manager selection criteria, I guess you could categorize things as, value, contrarian, opportunistic, momentum selection. Now, sort of what's your philosophy when dealing with all that? What's your criteria?
We look for businesses. When I had the funds that I had, we had institutional clients, and the best allocators to us looked at, while they weren't making an investment in our GP, they looked at us as a business. So what's the moat around the strategy, right? What unique thing do they have that separates them from others? And so that tends to focus our energy. So that wouldn't be momentum, right? So it would be opportunistic and to some degree value to a lesser degree. But I'll give you an example. Luis mentioned the farmland manager that we have. Phenomenal, incredible moat around their business. We've been working with a manager that the entire group came out of Harvard Management Company, many years on Wall Street. And they do a lot of trade finance, and they have a really unique vendor credit or vendor credit default swap program that basically they provide credit default swap insurance to a vendor who may be selling to Macy's, right? So Macy's is a distressed credit, and the defaults only trigger if Macy's goes bankrupt. And they're short-term in nature. They're 6 months contracts, and the fund will generate returns 15 to 22%. It's amazing. And how a jeans manufacturer in San Diego finds a Wall Street firm to create credit default swap insurance on Macy's is a heck of a moat around their business. And that is it's capacity constrained. And we're really the only firm that allocates or has access to that. So that's an example.
That's very interesting. I hear Bill Gates is looking for some against Tesla. So
the guys that run this, we were talking about how these companies go bankrupt, and he said Radio Shack would never. It took them forever to go bankrupt. So anyhow, that's
true. It takes a very long time for that to happen.
About 15 minutes.
Yeah. Okay.
Good. We only have about 200 more questions, so we're fine. And by the way, feel free to chime in. You hear something that's of interest to you, you want to say something, don't wait for the end, because it's not going to come. We're going to go, like I said, we got plenty of questions. We'll go for another hour or two.
Mark, I would add one more thing, just in terms
Sure.
of looking forward. I think that there is going to be, as I mentioned, some of the issues, problems on the middle tranche. There's going to be a huge opportunity in distressed credit. I think it's not, we may be a little stressed, not even that, but I think distress going, looking down the road is going to be a huge opportunity.
I would see some, with the leverage that's been out there and the leverage that some of these middle market companies have gotten, it's, they're just able to afford it right now with their current cash flows. When that cash flow dips a little bit, it's going to create those opportunities. So it's going to be a very interesting area. Suzanne.
Well, I'd love to segue into that whole discussion, like from a macro point of view, where, we talk about the 2008 crash and the difference between now, the banks are pretty secure, I think, today, right? and then private equity firms also, say, they're probably not gonna be hit as badly as they were hit in 2008. So, if you're looking at distress, who are the players? Maybe that secondary level of credit, maybe, operators like, so I was talking to this guy who has this platform for, retail lending, for people who run retail shops, restaurants, etc. And they're lending that to them at like, 30% interest rates, 40% interest rates, etc. I'm not sure if you can sustain that if interest rates go up in general, right? So I mean, you have this whole group, this whole cohort of Americans who are getting older and looking to sell their businesses, and they're all going to be looking to sell. I mean, they kind of put it off after 2008, and then I think maybe 2020 kind of sped it up some. But any thoughts on all that? Macro perspective.
I'll give you a quick story on this. And when I began my career, I began at Blankroom, which is a competitive law firm. And it was around, the early 90s. So the credit pinch on the savings and loans was coming into play, right? A lot of real estate deals. Well, our real estate lawyers became the best workout attorneys in the firm. So I think you're going to see a lot of switching. I think you're going to see people going back to banks and lenders. And I think particularly the deal nature of some of these fund managers will lead to some very interesting solutions. I think we've seen that in the secondary market. I think it'll continue with this market moving on. Having said that, it's going to be a lot of bankruptcies that still happen.
Right.
Right.
The other gap is that, a next level VC funding, right? So a lot of people got their seed capital, Series A, et cetera. And then, it's always known as the valley of death, which is that Series B through Series D. Right? But I imagine it's going to get worse.
And probably leads again to another very interesting people looking for those companies that have great technologies. We're in the midst of developing them and getting them at bargain prices after they come out of bankruptcy court.
Right.
I think that's going to weed out a lot of the companies that pretend to have a value proposition for the market, and it's nowhere there. And that goes back to the manager selection process to see all these venture capital managers that are selecting ideas just because they're part of the trend, not because they are so flushed in cash that they have to allocate, and they've been allocating to things that I wouldn't put a penny on personally, and now yet alone for somebody else's money. But and that's going to weed out all those opportunities. I think that we're going to have a much better technology market and venture market if those things start to happen.
I think that there's probably more opportunity in the early stage because on the venture capital side, because they're not as subject to the growth that the later stage, the valuations on later stage venture capital are crazy.
Well, the thing is that if you are not able to prove your value proposition and your fundamentals after a Series A, you should be done. I mean, I'm not going to continue pouring cash into an idea that is not cash flowing positive.
Correct.
I'll give you 18 to 24 months.
Well, we're seeing that even at the Series A. I mean, we're talking about a really big Series A crunch right now. We talk about it a lot. We do pre-seed through A, and the bar for Series A has just gone up astronomically because there is so much money going into seed and pre-seed deals. So I think even so, I agree completely. I think
But I think they also have to be solution driven. My firm partnered with a group called Overflow.co. And take a look at their website. What they do is it was started by a Google engineer, and they came up with the notion of putting technology onto a philanthropy's website so that when you hit the button, you donate stock, appreciated stock or other appreciated assets. You go to a series of screens. It ultimately identifies where that stock or where that asset is. You make a determination you want to give 100 shares of Apple to your favorite charity. It shuttles that over to our firm as a broker dealer. We liquidate, and the charity gets the wire transfer, sometimes as little as 72 hours, which before, if you've ever donated stock to any charity, can take months to clear stock in a charity situation. So we partnered with them, and the reason why is that Salesforce Ventures gave them a Series A of $10 million, and a guy named Bob Kraft, who I think knows his way around football, gave them funding as well. So I think that you're absolutely right. There's a boatload of capital out there that's being allocated, but you are correct that unless the strategy proves itself out and starts to have cash flow, et cetera, it's not going to go anywhere.
So how about another
Yep.
scenario? Like, so my other scenario is that you've got all these people who are retiring, who have run businesses forever. Maybe their businesses aren't cash flowing that well, but maybe they have a lot of real estate assets they built, their business off of. We know real estate is appreciating.
Mhm.
Maybe businesses aren't doing that well because of Amazon. People have moved to virtual, whatever, Any thoughts on that? Like, I mean, would you be putting money into a private equity firm that's, buying out, like rolling up retiree?
So
businesses?
let me give you a perspective because we've been working on that market for a while. One of the families I advise owns a community bank, and I help them create the content that should be going out to talk to the constituency, which is middle market companies, anywhere between 20 to 25 million dollars in revenue to 200. That's the sweet spot. And the topic that when we put out something out there, the most popular topic is succession, business sale, and the different structures that you can use to be able to basically retire these guys that have been running their business, and now their kids are either doctors or doing a startup, and they just don't wanna. And we have like the demand for that content out there. It's real. I mean, it just tarnishes the rest of the content that we put out there. And the solutions are endless. The thing is that people are not well educated. That middle market frame of companies, they do not understand what they have possible. I mean, that they can do grads and start giving it to their children, or that they can work on an ESOP and involve they don't necessarily have to sell it to a private equity firm. They can do it throughout 6-7 years and just do, owner finance. There's so many opportunities, and
So
that
you're saying
lends
sell
itself.
to employees, right?
Yeah, the sell to employees, I think, is the best way out, especially these middle market companies, because if you bring in a private equity firm, a full private equity firm to a middle market company, they don't have the experience in the scale that they're working in. So they might write a check for $50 million, but they don't know how to deal with the guy that has been going to work from 9 to 5 and that last 20 years.
Yep.
And is pushing bottles through the process. So that's.
But I'm saying, is it worthwhile to invest in a manager who has a strategy that's looking
That
at
would be great.
these kind of opportunities?
I think that's
why
happening.
I'm sorry, I think I've seen the move in the last 2 years, particularly during COVID, far greater interest in private equity, venture capital, and real estate for those very reasons. Very reasons.
Luis,
Same.
what do you say? Why don't you give us your take on this?
So, yeah, I mean, I've seen a lot of flow going into, and we've actually gone into a pretty similar direction as, getting at funds focused on some in the middle market space. We think there's a lot of demand still, where we are. And for small businesses, there's a manager that we work with based out of Pennsylvania that looks at small businesses and franchises, and they, they're unique in that they do understand, the small mom and pop business very well. They've done a number of funds, and they've been able to help those folks transition their real estate assets, their credit assets, and the equity of their businesses, and actually, in many instances, take them to the next transition of growth where they're suitable for a larger private equity shop. So. Yeah.
Great. Well, I guess on that, I'm going to segue a little bit and have you comment, then I want Suzanne to follow in. And talk to me a little bit about emerging managers from your point of view. What role do they play within a larger portfolio? People that you're advising, and when do you say, hey, makes more sense to go after an emerging manager than an established manager here? When does that happen?
So with larger managers, what I'm looking generally, and let me answer that part first. For larger managers, they generally serve certain core areas that they're really solid at, right? So if I want to look at call it the energy space in private equity, I'll look at Blackstone, I'll look at Angelo Gordon, I'll look at Quantum Energy Partners. Where I look for emerging managers, it's usually in capacity constrained spaces where, I don't have to worry about, Morgan Stanley snapping up $250 million of the capacity, and, I'm left with 50 million. So I like the emerging managers that have a unique value add that can't be replicated by a $5 billion shop. And, in those spaces, some of the things I've looked at include, private equity shop that focuses specifically on mom and pop industrial companies, mom and pop franchise businesses, and local businesses and community-based businesses. This is a firm out of PA. Another one is one that I mentioned earlier. The CPI mirror strategy. He's able to replicate, about 70% of the correlation to CPI. So when I look at things like, tips funds and, outside of getting into some esoteric arbitrage strategies and inflation, there's nothing that replicates what he's doing that's available, at least that I've been able to come across. There's another fund manager that does small business administration loans. So he runs it as a hedge fund strategy. And
Amazing.
those are some really unique places to get really solid risk adjusted returns in an emerging manager space. I don't have to compete with the big private banks, the RBCs, the Goldman Sachs, the JP Morgans, and for our clients, whether they're, the family office clients or the high net worth, ultra high net worth, providing access to these types of managers. A lot of them just don't either have the full team to be able to know where to look for. That's why, they'll go to, a firm that does cap intro in emerging managers. But particularly in our environment, I find it interesting that folks are pulling money out of emerging managers, because those are the folks that are I think will help us better weather whatever environment we embark on over the next 1 to 3 years. So
Great. I'm going to give Suzanne the final word here, but I really want to thank our panelists, Suzanne, Louise, Blake. You guys were all fantastic. Great job.
Thank you very much.
thank you.
And thank you, Marty.
So your final comment on emerging manager space here.
I still think it's a growing area. I still think you're seeing large allocators, and I'm talking pension funds that will take a sleeve of capital and allocate it strictly to emerging managers. That doesn't necessarily mean that every startup manager should be calling CalPERS and CalSTRS to try to get an allocation. But you've got to rely on people like us, who are the prime brokers, that are in the marketplace and are seeing where that appetite is, because the ability to have allocations is exceedingly difficult unless you really know the territory, as they say. So I would say that get yourself good partners in your legal capacity, your admin capacity, your CPA capacity, and here we go, baby, your prime brokerage capacity, because
Absolutely.
we've got our ear to the ground out there. And for example, we're helping to launch a long short treasury trader. He's going to trade probably $100 billion in treasuries and be flat at the end of every day. Think about that for a moment. So there's a lot of opportunity out there. I will tell you that I don't think in my career I've ever seen this much cash as I'm seeing out in the marketplace, searching for ideas. And that can be a very double-edged sword. That could be the sword that everybody runs into, as you say, the crowded trade, and then everybody gets their head handed to them when a COVID hits, and it just discombobulates the entire market. But I think emerging managers have got a huge place right here in this particular marketplace. Thank you, Marty.
Thank you, Marty. Great job,
Great
guys.
job, guys. Thanks.
Thank you, Marty.
Thank you.